As labor cost data for the first quarter show no signs of weakness in the labor market. The news setting the yield on the 2-year above 5%. And joining us now is Kevin Flanagan, WisdomTree head of fixed income. Kevin, it is good to see you. So I was talking to Julie, Kevin. I don't know if you heard that. I thought, hey, maybe Jay Powell. I look at ECI today, Kevin. I look at home prices. Maybe Jay Powell thinks it's time to put a hike back on the table. What do you think?
No, I'm going to go with your segment right before me. Nah, I don't think we're going to get that yet, but I do think he's going to reiterate their disappointment in the lack of progress on the inflation side, and higher for longer is where we're at. I couldn't agree more.
So higher for longer is where we're at. So what do you do as an investor then in this market? And what are the implications of higher for longer, especially if it's higher for longer with, sort of lousy consumer confidence readings and maybe some more rocky economic data?
Well, we like to call it kind of like the new old rate regime, where rates have gone back to where we were prior to zero interest rates, negative interest rates, quantitative easing. So I think you have to look at it from the more traditional role for fixed income. And one of the ways to focus on it is to still inverted yield curve. So we like Treasury floating rate notes as one end of, say, a barbell strategy, and then looking at something that's more of a core benchmark type of weight on the other end, and try to toggle back and forth, because I think we are getting to the point where you do want to leg in a little bit, maybe lock in some of those yields a little bit further out on the curve. And when I say further out on the yield curve, I don't mean long duration. I'm talking about, getting into that 3, 4, 5-year kind of area.
I'm interested, Kevin, though, you see, evidence here the economy is slowing. We were pointing out the latest inflation indicators we're getting. People are discussing stagflation as a possibility. Do you see that, Kevin?
No, I can't say I'm that old that I actually was in the business for stagflation, but I do remember studying about it. And I think, the inflation part, I wouldn't necessarily argue with, but it's the stag part. If you look at the GDP numbers we got last week, on the surface, they looked softer than expected, but underneath, if you looked at real final sales, which is the underpinning of the economy, consumer spending, business investment, residential outlays, 3 quarters in a row now, that's been above 3%. So I would not be in that camp at this stage of the game.
Do you think we're going to end up seeing 5% on the 10-year?
Julie, great question. Yeah, I think there's a shot we make another run at it at this stage of the game. I don't know if it would be sustainable, much like we saw last October. What I find interesting, though, is that fourth quarter rally in Treasuries, you all were mentioning it just a few minutes ago, we've retraced about 75% of that. And I think you're getting to the point now where the market is better priced for a Fed being on hold for a longer than expected period of time.
And Kevin, for those fixed income investors who are listening right now, you did a good job of outlining where you see opportunity. Where would you avoid, Kevin?
Well, I wouldn't necessarily go too far out in duration. You're just not getting compensated to do that. And we've seen a lot of elevated volatility in the bond market. So if I can get income without the volatility, that's where I would focus on. And that's why we like Treasury floating rate notes as one of our high conviction ideas.
Kevin, great to have you on the show. Thanks as always for joining us. Appreciate it.